Hello, everyone, and welcome back to TradeFinder Live. It's great to be back with you all, especially during market hours on this Tuesday. I'll be introducing Mr. Rob Roy, who we're all here for in just a moment. But first and foremost, we have to cover off our disclosure disclaimer agreement. This is something we have to do for all of our webinars or live events. And essentially, the main thing to take away from it is that we are not licensed investment advisors in the United States. So nothing is to be taken as personal investment advice. Now, we have this available on our website, so please feel free to read it in leisure. Read it in detail at your leisure, rather, or feel free to take a screenshot of it now if you like, but that's the main point to take away from it. Other than that, the PPI report came in a bit hotter, and that seems to be handling or meshing pretty well with the market. Market seems to be handling it pretty well. In addition, Fed Chairman is speaking at the international conference, so I'm sure we'll have some feedback from Rob on Powell's comments there at the conference, and I have some questions for Rob as well, crypto-wise, so very excited for this session. Let's go ahead and get it started. Without further ado, Mr. Rob Roy.
Hi, everyone. Welcome to this week's TradeFinder Live. I do apologize for starting a couple minutes late. That's on me. Started a computer update at 12:45, and it decided this was a good day to run a whole bunch of updates. So, I'm familiar with that. So we're here. And as you mentioned, Zach, we did have a PPI report. We've been talking about this for several days now. Did it in the U.S. market update where we had the PPI today. The big one, the CPI, is tomorrow. The PPI report came in a little bit hotter than expected. We do have Chairman Powell speaking at the Foreign Bankers Association meeting in Amsterdam, and I've been watching that this morning, and he's staying pretty pat on the fact that they're going to hold rates flat. They still want to see what the current rate hikes will do as far as inflation, admitting that it seems to be leveled off, but maybe with a little more time. So no hint of rate cuts at all, but also no hint at rate hikes at all. So we're kind of status quo. We'll see if that CPI report tomorrow changes anything. A lot of people feel like the Fed gets those numbers early, so perhaps Chairman Powell already knows what the CPI report is going to be. But we're just basically doing what I thought we would do, and that's run up here, kind of consolidate underneath this previous wave 3 high at the end of March, and sit and wait for these reports to determine if we can break above that resistance level and head up towards the zigzag target, which, as you know, by now, if you've been watching, is up around 550, or if we're going to kind of double top here, come back down. The wave 4 is only at 33%, didn't quite make it to the 38.2% level, and the algorithm still has this labeled green, which means that's the active recurrent wave. So it's not confident yet that the wave 4 is done. So with those things, we have to keep in mind the possibility of some sort of a move back to the downside. I put the moving averages on. You can see that on this first part of the move, maybe we got a little separation from the 10-day moving average. So going sideways here is exactly what you want if we are indeed going to take out that wave 3 high. Go sideways a bit, let the 10-day moving average catch up, gain some momentum and energy, pardon me, and then break above that wave 3 high. So from that standpoint, there's a no harm, no foul kind of thing with where we are. We want to look at the intraday chart. We look at the 3-minute chart, which is one of the wonderful things about this software. I did want everybody to know, I know a lot of you have gotten the software. You've made the comments, lots of good comments on the U.S. market update. For those of you that have gotten the beta version, you do get live Elliott wave. I wanted to show you this area down here. If you see this where it says insufficient data, I've set my data points at 610. The default's 300. I've always felt like if an algorithm is going to analyze data, let's give it more data to analyze. 610 is a fib number. And so if you see this, it's just telling you that currently there's not 610 bars to analyze. So you just kind of condense the chart a little bit with the minus sign until you get 610 bars. And then if there is an Elliott wave pattern, it will label it for you. And at this point in time, you can see that we aren't labeling an Elliott wave pattern yet. We'll see if that pops in once we give it enough data. And currently, really not showing an intraday Elliott wave pattern. but you can see that we did have a gap up back on the 10th. We filled that gap. We gapped up again on the 13th on Monday, came down and filled that gap. No gap up today, and just coming back down. So just kind of churning sideways here on the intraday chart, and then we'll see if we can move higher. We actually did have an intraday pattern yesterday, and the highs today fulfilled that pattern, and now we don't have a labeled pattern on the 3-minute chart. But if there is one, it will show it to you. So let's go back to the daily chart where we do have an Elliott wave pattern labeled, and just use these buttons if you want to spread the chart out, condense the chart. You can hit that refresh button and it'll take you right back to where you were when you opened. So just a lot of cool features in the software that you just have to spend a little time playing with it and learn about it. But I wanted to show you those features. So we did have this triangle here. If you've been watching, you know that we had symmetrical triangles on the S&P and the Dow, and then the Qs and the IWM, which we'll look at those markets here in a moment, have wave fives, which could mean a return back to the previous 4. Now, the patterns are very similar, but the labeling is slightly different. So which one is right? I mentioned before that when we were kind of all over the place on the patterns, normally when there's, I call it discombobulation, they do tend to come back together. The patterns have, the labeling is different. So which markets are leading? Are the Qs and the IWM leading, or is the S&P and the Dow leading? So here's the chart of the DIA. And just as I mentioned, it's in a wave 3 with a wave 4 correction. We didn't have quite the same symmetrical triangle on the DIA, but everything else is about the same. We did make it down to the 38.2% fib level here on the wave 4, but it's still the active wave. And if you're wondering, well, when will it confirm that? It won't confirm a wave 5 until the previous 3 is broken. So if we break above this resistance level, you'll see that turn purple, and then we'll have a green 5 up here on the SPY and the DIA. Little more separation here from the DIA and the 10-day moving average. So a little bit of a pullback here on the Dow so far today. That's kind of to be expected. Now let's look at the Qs. That's the one I think is really going to move. And there's that wave 5 that I was talking about. And once again, the Elliott wave algorithm just kind of nailed that move. We went right smack into the middle of that tap box, time and price projection, which is where it thought the wave 5 would go. We have bullish crosses and all these 10-30 moving averages. And then the Qs are just kind of maintaining a status quo. So all the markets are looking the same as they're consolidating here underneath resistance, waiting for that, in my opinion, the CPI report tomorrow. Maybe Chairman Powell has already given us his view that regardless of what the CPI says, and once again, comment that a lot of people think that the Fed gets those numbers early, that there isn't going to be any chatter about a rate hike. Will that be enough to propel us above that previous resistance level? Or is the market going to be disappointed that there's no commentary for a rate cut either? And then we kind of head back down a bit. Now, the issue here with the wave 5 on the Qs is that it went above 100%. It went to 124%. And so we're only looking for a 61.8% correction, which would bring us back down towards this wave 3 high, not a move back to the previous 4. So if you're newer and you're not familiar with Elliott wave, the rules are if the wave 5 exceeds 100%, you only look for a 61.8% correction. If the wave 5 goes less than 100%, then you look for a correction back to the previous 4. That's how it works. So there's the triangle that we had on the Qs, the breakout. All these markets are going to look the same. The interesting thing about the IWM, there's that wave 5 again. So S&P, Dow, wave 3s and a wave 4, and the Qs and the IWM with wave 5s. This one, however, did not exceed 100%, and we came back down to that previous 4 level. So the IWM has kind of already done what it needs to do. And if you watch the insiders meeting, if you're already an alert subscriber at ewotrader.com, you know that Jeff and I talk about how the IWM seems to march to the beat of its own drummer. So it does things a little bit differently. I'm a believer. I don't know if you are or not. Some people are, some people aren't. That small caps, i.e., the Russell, gives you an indication of risk tolerance in the market, risk on, risk off, if you will. And we are kind of marching up. And if you felt like this is it, we're done, and we're heading lower, seems like maybe the IWM wouldn't be moving back to the upside. The key here with the IWM, again, you know this, but just for people that may be viewing for the first time, the IWM has been arranged between 190 and 210 going back a year or so ago. Then we came down to 170 to 190. We got back into this range, and you can see how we've just been kind of moving sideways here through this range between 170 and 190, basically since the beginning of the year. Now, can we break 210? Do we start a new range? For whatever reason, the IWM likes to run in these 20-point ranges. So do we move up and have 210 become support that's been resistance for so long? Or does that resistance hold and we're headed back down to test 190 again? I think once we get the CPI report out of the way, we'll know a whole lot more about what's going on. So if you are an alert subscriber at ewotrader.com, Thursday night's insiders meeting, we'll have all this information. We'll have the CPI out of the way. We'll see how the market reacted to it both tomorrow and Thursday. And I think we'll have a much better idea of where we go from here as far as the markets. But right now, all of the markets just kind of hovering underneath trading ranges, albeit slightly different modes of getting there, whether it's a wave 3 or a wave 5. So that's what's going on with the IWM. We had a question yesterday during our Ewo Trader Live that I thought I would bring back up before I talk about some of the other things that we want to cover today. And the question was regarding the CQQQ, and that's the China tech ETF, if you will. And you can see it's holding in there pretty well. It's in a wave 3. We had this ascending triangle. Another great feature of the software is that when you've brought a chart up before, it remembers any lines that you've drawn on it. The legacy software didn't have that. You had to go back and redraw them all. So once you've put lines on and then you bring the chart up days later, it reminds you of what you were looking at before and what happened. So I just think that's an amazing feature. So we had this ascending triangle, clear break to the upside from that triangle. Now we do have this little range here between 35 and 37 and a half. That was a trading range at the end of last year. We broke to the downside out of it as we formed this ascending triangle, but we used 32 and a half as resistance. What was support becomes resistance, and then the break to the upside. So from an international standpoint, I think if you're looking for a place to be, a consideration would have to be China. Another popular China stock that people like to look at is the KWEB. That's the internet. And you can see we have broken above our resistance level there. We're a little bit overbought, so some consolidation here. One thing that worries me about this one is we're starting to get a little separation between the 10 and the 50-day moving average. You've probably heard me before say one of my favorite phrases in the world of trading. A lot of our subscribers have said just that one tip has helped them in their own trading, that no security in any time frame gets very far away from the 10-day moving average. Well, the same thing happens on the separation between the 10 and the 50-day moving average. The 10-day moving average is the short-term moving average, obviously. The 50-day moving average is what a lot of people look at for trends. And then I had a question asked in the U.S. market update, and I read them all each and every week. I respond to as many as I can, time and travel permitted, but I read them all regardless. And so a question was asked, why do I have the 10 and the 30? This fuchsia line is the 30-day moving average on the charts. And the reason for that is floor traders have told me, and I joke about this, but it really is true. To find out what really goes on the floor, you have to talk to ex-floor traders or ex-market makers. The current ones won't really tell you what's going on because then they're divulging their secrets and what goes on throughout the day. But ex-floor traders have told me, and a few weeks ago, there was someone that commented on the U.S. market update, and that's on YouTube, by the way, the Elliott Wave Options channel, that he was an ex-floor trader, and that's exactly right. That the 1030 cross is something floor traders look to give an early indication of a trend. So that's something that would occur before the 50-day moving average started moving. Obviously, the 10 and 30 are shorter term. So they would use that to give an idea of an early entry into a potential trending pattern. So you can see they're all moving up. We're not too far separated yet, but we're kind of getting there. So maybe on this KWEB, we need some more sideways stuff and allow that 10-day moving average to flatten out a little bit, allow the 50-day to catch back up, close this separation a little bit to see if there's a continued move up. But I would be a little nervous about going long on KWEB right now just because of that. I like the CQQQ better from a standpoint of looking at what's going on in China. I think we should look at the VIX. We talked about this in the update as well. You can see we did bounce off that. This is where we were on the weekend. We were testing the low here back from March at 12.5. We had broken out of this trend channel that lasted for 1, 2, 3, 4, 5 months. We were basically in this trend channel. We tried to break to the upside on the VIX and came right back down, broke to the downside, and now we're just trading right at the 10-day moving average. A comment was made in the market update on the fact that, well, with the VIX being this low, you would expect the volatility to go up. And I can see that. I do want to remind everybody, though, that we have been lower than 12.5. We're basically testing those lows, not just from March, but going back to the end of last year was around 12.5 as well. But there is history of the VIX moving down into the 10 area. We broke 10 for a while. So my point is that even though this is support and we could very well break higher on the VIX, there is history that we can go lower. So it doesn't mean that just because we're down here that the market's going to go down and the VIX is going to go up. I can see where the thought process would be that's probably more likely, and I would agree with that. But the possibility is still there that we break this 12.5 level and go lower on the VIX. But for now, you can see volatility being priced into the market here due to the fact that we had that PPI and then the all-important CPI report tomorrow. And if you're not familiar with the difference between those two, PPI is producer price index. Think of that as wholesale prices. So if you're a business, you know what you pay wholesale for your goods. And then the CPI is the consumer price index. That's what consumers pay. And obviously the difference if you're running a business between what you pay and what you can sell goods for is your profit. So when those get squeezed, it squeezes profit margins. So you kind of look not just if they're both hot, but we've had a couple of readings where the CPI was hotter and the PPI was lower. Okay, well, if companies are being able to pass those prices on to the consumer, well, that would be a good thing because that would enhance profitability. But if the PPI is higher and the CPI is lower, well, that means businesses are being forced to pay higher prices for the goods and they're not able to pass them on to the consumer. That compresses profit margins and that makes it a little more difficult when you get the earnings reports. We did have some consumer data that came out yesterday that shows that delinquencies on credit cards and autos is rising. It's the highest level it's been pre-pandemic, but not as bad as it was during the pandemic. So how do you view that? Debt levels are mispayments or late payments are on the rise, but not as high as they were back before COVID came and we went through that depressed area then. So that's the VIX. I know that people are looking for definitive answers on direction. Nobody knows beyond the shadow of a doubt where a market's going to go. Not even Elliott Wave. I believe Elliott Wave is the best individual technical indicator that's out there. I've never been an advocate that you should only look at one technical indicator. We have our confirming indicators and we have extensive information on them in the education area on our website at ewotrader.com. You can read all about my favorite confirming indicators. You create a technical system. Find a group of indicators that work together. What I've tried to do, the CPI, or excuse me, the DMI can be a little bit lagging, but the CCI is way more responsive to the day-to-day movement. So I love the DMI as far as giving the strength of a trend, but it can be a little slow to react to a trend change, where the CCI is going to give you an immediate reaction. So the weakness in the DMI is then offset by the strength of the CCI. See what I mean? That's how you create a technical trading system. You want indicators that complement each other to create your system. Anyway, I digress. So let's go and take a look at another international market that I wanted to show you, Japan. People were talking about the Japanese market, and so I thought I would show you the yen. A lot of people have been asking about that lately. The yen had a big move. If you're not familiar with the news, Japan had been at 0 to negative rates for as long as I can remember. And then all of a sudden they started raising rates. I guess they finally decided that keeping rates that low wasn't the best thing to do, especially when there's more global inflation coming into the mix. So they started raising rates, and that put a big bid under the yen, but now it's leveled off. And we're consolidating underneath resistance here at 110. So you can see there's a trading range on the yen between 105 and 110. We want to look at our own market or our own currency, the dollar. You can see that we had this little bit of an expanding triangle. We broke down out of it. We tested the wave 4 there and the 50-day moving average. So we're in the higher end of the range. I would prefer to see the dollar come down a bit because that's helpful for U.S. companies that have international exposure from the currency exchange rate. I didn't want to see it come up and test these highs from the end of last year, but we did. And that's when it started looking like, gosh, we're not getting rate cuts. And then the whisper of maybe a rate hike. Well, Chairman Powell has poo-pooed that. And that he's also mentioned in his, I've said this a few times, but for those of you that may not have heard it, in the Q&A after the last meeting, he admitted that the Fed was going to slow the rate of reducing their balance sheet. When they reduce their balance sheet, that's a form of tightening. And so if they're going to slow that down, you can view that as kind of easing. When you're reducing your balance sheet and raising rates at the same time, that's a double whammy on tightening liquidity. So they're talking about not raising rates any further. They're going to let the data play out longer, so higher for longer, but maybe not another rate hike coming in, and then a slight lean towards easing by slowing the reduction of their balance sheet. And that stopped this upward wave 3 move in the dollar. So do we come down here towards 104 and move this wave 4 lower? Again, it's green, so it's the current wave. Or is the CPI so bad tomorrow that we have to start talking about rate hikes again? Based on this PPI report, I just don't see that, but it's more on Powell's comments. I'm one of the believers that they already know what the CPI is, or they have a great expectation of what it is. And so regardless of where it comes in a little bit hotter or not, I don't think it's going to be hot enough, but we'll see. I could be completely wrong there, but that's my viewpoint. So in summary here, I see the dollar staying in an elevated range, but probably in this trading range. If by some chance we come in with a really tame CPI report tomorrow, then you could see this dollar come back down, which would take any sort of thought of not only a rate hike coming in, but higher for longer. Maybe we start talking about, hey, down the road before the end of the year, we could have a rate cut. The Fed has said that there's one rate cut expected this year, but that move or that comment of slowing the reduction of the balance sheet to me sounds like the Fed's playing politics, because Powell's comment was also they don't want to do undue harm to the markets or the economy. And I don't know if he would have said that if it wasn't an election year. It seemed to be a reversal of pathways from previous comments. So I don't feel like any rate cut would happen until after the election, I guess is my point. So I would be looking towards the very end of the year for any sort of a rate cut. I think the Fed, if I'm right, that they're playing politics, is going to probably do nothing until the election. So I feel like we're just going to stay status quo into the election. We'll have an elevated movement here on the dollar. And then if we look at the 10-year on rates, you'll see that we came up, hit the 100% extension, looked like we were going to go up to that 161.8% extension. Didn't want to see a 5 handle on the 10-year, but we would have been approaching that if we got up towards those highs from October. And so now we're down here and we're clearly in consolidation mode on the 10-year as well. So maybe we're just in a bit of a corrective mode here. But all that speculation, just my thoughts. You don't trade on your thoughts. I learned that a long time ago. The market doesn't care what I think. The market's going to do what the market's going to do. And we'll see if I'm right tomorrow or if I'm way off base. But everything is consolidating right now. I would expect that to continue for a while. So that comes down to picking your spots, right? If the market's just going to kind of level off a bit, move up. I mean, the market never goes in a straight line sideways, but maybe a little up, a little down, et cetera. And then once we get the election out of the way, then maybe we get a stronger directional move. But maybe we break out before then. We'll see. For those that watch election cycles, is not one of my big things. I tend to watch the charts more and listen to the Fed commentary and watch the bond market. Those are the things that I look at to see what's going to happen. But you have to trade what the market gives you. Learned a long time ago. The market's going to do what the market's going to do, and it doesn't care what I think. So I'm just sharing my thoughts with you. And the decisions that we made will be based on these movements. So back to my point of, I think it's a stock picker's market. There's opportunities. We've had some good opportunities from our AI. And I think that's what you want to look at. I do have a case study consideration for you moving forward for this week. There is not a qualified AI signal for today, but there's a trade that I've been watching for a while that I think is a pretty good point to enter. And while I'm talking about previous case studies, let's go ahead and look at some of the previous case studies that we've had here in the markets. And one of those that I wanted to talk about, we closed all the rest of them off last week, but on the 30th of April, we looked at TT, and that was Train Technologies, and that's working pretty darn well. So hopefully you're following along with that one as it has moved to the upside there, and that's really just following along with the ones that we closed out yesterday. Basically, we're really working out extremely well. I'm going to bring up something on our website that I wanted to share with you. Most of you are probably aware, due to an error on my part, I sent out kind of a bonus case study consideration on TradeFinder, and that was on Starbucks. And so that was a sideways trade in Starbucks. So let's bring up the chart here. And it kind of goes along with what I've talked about. The difference between TradeFinder is we look for case study considerations, and then you're on your own as far as closing them out. However, on our website at ewotrader.com, if you're an alert subscriber, you get entry alerts, any adjustments, and exits. So on Starbucks, that was sent out. Hopefully you followed along with it. I got some comments on people that were asking about it. And I thought at this point in time, I would go ahead and show you that. So I am going to switch my screen here. I know that this is always, when I do this, a bit of a flip of a coin on whether or not I get it right or not. So we'll see if I can switch you over and show you the chart. And here it is on our website on Starbucks. So you can see there, we close that out with a nice 36% gain. And I'll show you the chart back in a second. But we had this entry, and all of our alerts have all this information on them, including the chart. So it shows you everything that we do as far as the strikes, etc. I think this is just a little bit larger for you. And we have a mark-to-market graph there, which shows you where the position is every single day. It was down 20%, ended up with a 30% gain. There's commentary on what we're doing. And then the exit was sent out on the 7th. And the reason the exit was sent out, if I bring this chart up, is because of the fact that we were down to our area here of support. We had 70 strikes. It's been a support going all the way back to the end of last year, and felt like we may bounce from here. So oftentimes we'll keep a calendar spread or a butterfly a bit longer than this, but the odds were we were going to probably bounce from here. And if you've been following along with this, that's exactly what happened. So we ended up with a 37% gain. That's the alert that was sent out to our subscribers. And so that's what they enjoyed. And then depending on your exit, I'll bring it back to the chart of the S&P. So endeavor to go through and make this change again. I think I got this right, Ryan, this time. I don't think I screwed it up. So you can see
you
that's
did.
exactly.
I'm so proud of you right now.
It takes a while to teach old dog new tricks, I'll tell you. That's where we were when we exited, and we exited because we thought it might bounce, and that's exactly what happened. Now, if you're still in this, if you're still watching it, we did bounce to the 10-day moving average, and we're coming back down. So if you didn't get out of it yet, I would continue to hold it into Friday for expiration and see if we move back down. And if it does, then you could possibly even generate a better gain than we did. That would be my commentary there. If you were still, if you follow this trade and you're still holding it, see if that 10-day moving average acts as resistance. Pretty good example there of my comment that no security at any time frame gets too far away from the 10-day moving average. You can see on the drop, we were separated. We came down to support. We bounced back up. Just all classic technical stuff. And now we're bouncing back down. Perfect doji yesterday, back down today. So we'll see if that comes back down. So I just wanted to make the comment there, since I sent this out in air, that if you're still holding it, perhaps you just keep it a few more days and see if we continue back to the downside. But we nailed the exit, at least till now, perfectly. And that's the beauty of the alert service, where you get alerts for exits as well. Zach, I guess I'll let you ask me the question that you wanted to in the whole crypto world. But for now, before we get to that, I did want to go back and update on oil. We're just pegged here at 75. We had this perfect zigzag pattern. If you haven't seen this chart before, the zigzag here, we had a perfect 61.8% B wave correction, which yields a 100% extension. You want to know why we look at Elliott wave and fib levels? Because it just works time after time after time. Again, nothing's 100%. I'm not trying to say it is, but it really does put more probabilities in your favor. And so you expect a 100% correction. That's exactly what happened. And we just stopped dead there, just hit the floor right there. And 75 is going to be the key level to watch. Do we bounce back up in oil? If we do, software has labeled this wave 4 now purple. So it thinks that this wave 4 is complete. Again, it's not a 100% thing, but it's kind of leaning towards maybe we do get a bounce up in the wave 5. And if we do, then we start to look at higher oil. And I hope that doesn't happen, because it's painful enough at the gas pumps now. I've joked about it. You all know it, that when oil goes up, the prices seem to be reflected at the gas pump the very next day. But when prices come down, it takes a while to work into the gas pump. How we can get along with that or get away with that, I don't know. I remember back, President Obama joked about it. He even joked about it. And I was like, well, do something about it. If you're aware of it too, why do we allow them to get away with it? And then there's all the speculation of, all of the uh, power that the oil companies yield in Washington, et cetera. Blah, blah, blah. More stuff for our conspiracy theory shows, Zach. I think we're going to have two of them.
Can't wait for that
We
one.
have so many things to talk about regarding those lines. So that's where oil could go if it bounces off this 100% level. There's still a slight possibility that we extend this down to the 161.8% level, but so far it's being stubborn there at 75. And with all my travels, I can tell you there's still plenty of people on the road. So the economy would have to weaken, in my opinion, again, just my opinion, the economy would have to weaken even more and people stop their travel plans. We're coming into travel season with the summer on the horizon. Is that an environment where we're going to move lower? I guess if the data starts to come in to show that people are canceling their travel plans and not going anywhere, that could bring oil lower. We all know that OPEC doesn't want oil prices to go lower. They've seen the end game. They know they have a limited amount in the ground, and they have openly said they want to make as much money as they can with the supply that they have left. So they're not in favor of having oil come back down. And we used to joke about, maybe you remember this, in the pandemic area where oil prices came down so far, there was a very short period of time, like the last week of a futures contract in oil, where you could get paid to accept a barrel of oil. So if you actually wanted to go into the market and buy that, they would have paid you to store a barrel of oil in your garage. That didn't last very long. It was just as a contract was rolling over, but it was a very odd thing that normally never occurs. But anyway, just digressing a lot today, Zach. So I want to stop doing that because we promised yesterday that we would have a little extra time for Q&A today. I'll just go ahead and show this now. I'll do it at the end. So stay to the end if you want to see what today's case study alert is. Let's get some questions now, and then we'll bring that up, and then you can show the folks how they can post an idea on this website, which is one of the great features here in the new software platform.
Absolutely. Yeah, that sounds like a great plan, Rob. And just real quickly before we go into questions, I just wanted to highlight what you were showing, illustrating on that previous chart of Starbucks that just really, really highlights, emphasizes your pillar of no security in any time frame gets very far away from that 10-day moving average. Is kind of a mouthful sometimes because I have it so memorized. But with even a stock like that, a chart like that has such a drastic drop, you can see how quickly it got back up to the 10-day moving average. So anyhow, you explained it far better than I did, but I just wanted to highlight that point as I thought that was super interesting. So let's go into the first question here from Manuel on mRNA.
It's a good place to start looking. Moderna, everyone was familiar with the name during the pandemic, and then we kind of had this big move to the downside here. So if you don't want to move the chart like that, if that messes you up, you just condense it here, and it'll allow you to stay where you are and see what happened in the past, and then again hit this reset, and it takes you right back to where you were. But right here you can see that Moderna is moving up. It's in a wave 3. I want to see what the DMI looks like. There's a few of these kind of charts that are looking this way. So why, with basically being past the pandemic, et cetera, is a stock like Moderna going back to the upside? It's a defensive sector. So there are people that are putting money in defensive stocks, which means they're worried about whether or not the market can break that previous wave 3 high on the S&P and move higher. So just like I had highlighted on the Dow at the end of last year, we had a pretty strong move in the Dow, and that was market rotation as well, moving into both safer stocks with concerns that I had that didn't come to fruition, that we would see weaker economic news earlier in the year. We're starting to see chinks in the armor now, especially with that consumer report yesterday. But I thought we'd see them sooner than we have. The U.S. consumer just finds a way to spend. We know they're spending on debt, but they're still spending. And so when you see stuff like this, healthcare is a defensive sector, and that's why this is going to the upside, is there's rotation into more defensive-minded stocks, figuring that that's a safer place to be as the economy weakens. If we're not going to see cuts for a while from the Federal Reserve, it's going to put more pressure on the high-tech stocks, but good on you for asking about that. That's a place that money's moving. As far as the technicals here, we broke above resistance in this wave 3 at 110. And as long as we can stay above that level, I think you stay long this stock. The only thing that would concern me is if we broke back below 110. It was resistance for a while. As you can see, what was resistance becomes support. We had a bit of a ascending triangle here. It's rather shallow, but it is an ascending triangle nonetheless. And we broke to the upside. And the DMI down here is pretty constructive for Moderna moving higher. Little bit above the 10-day moving average on today's move higher, but that's a place to look if you're worried about the U.S. economy and if we're not able to break those wave 3 highs and move higher. So I'll try not to expand so much on these so we get more in, Zach.
No worries. And I just want to remind everyone out there that's joining us live on YouTube to go ahead and hit that like button if you are enjoying the webinar so far. It goes a long way for us and the algorithm in YouTube. And so that's a quick and free way to support us if you enjoy the content here. We are also going to be moving solely to YouTube and other streaming platforms, but we're going to be taking Zoom away essentially from TradeFinder altogether here in the near future. There will be more releases and newsletters on that to keep you informed on when the exact date will be. But just keep in mind that we are going to eventually be completely out of Zoom, and so we will be available on YouTube or the other social platforms we are currently on. Let's go over and look at BABA for Billy.
BABA, I've been looking at that this morning too. So another great question, and I wanted to further along with what you said regarding Zoom. Zoom has become, for whatever reason, a bit of a nightmare to work with. You saw that we had issues yesterday with our Ewo Trader Live. We'll be moving away from it on these bigger shows so that we don't have those kind of technical issues. But here's Alibaba, and here's what happened yesterday. Now, the reason I said it's interesting to look at is it was on the AI list. It wasn't quite high enough to warrant an alert, but boy, was it close. So this is going to be interesting to see how we hold this resistance level. You can see we had a big gap up yesterday. There's another one of the rules, right, Zach? I hate gap ups. So not only did we get too far away from the 10-day moving average on the high yesterday, but it gapped up. And so that's a double whammy. And now we're right back testing this support level. Another cool feature of the software, this is becoming a software class here. Didn't mean it to be that way, but just showing everybody all the cool things about it. You can put that crosshair, so you just go over there where it says cursor, change it to crosshairs, and it'll give you that exact price. You can see over on the right, 77.5 is that support level. We're currently trading at 78.61, so you can see the current level has the red flag there. That's where we are, and the black number is where the price is that I put it there. So 77.5 is where we are. I'm going to watch this one very closely because it was so close on the AI that I've got an itchy trigger finger here. It's in the China space, which I've already looked at. We saw the CQQQ on the technology side. Looks pretty interesting. Will had brought that up, by the way. Kudos to Will, one of our subscribers and consistent viewers. Always ask great questions. So that was a good spot on his point. And we'll see if we can hold this level. Now, if we hold this and start to bounce, I'm going to get really interested in this one. It was tantalizingly close to being the case study consideration for today. But I've got a different one that we've been talking about a lot, and so I'll save that. But yeah, I want to see if Alibaba can hold this level here at 77.5. Maybe it's giving us a break sometimes Jeff and I were just talking about this last week in the insiders meeting, that sometimes there's something that you're interested in. This is exactly why I don't want to chase this kind of stuff, but still interested in it. The AI likes it almost enough to be a full-fledged alert. It'd have to go in the speculative portfolio if I send it out, because it doesn't follow the exact rules that we use. But interestingly enough, adding the China factor in, et cetera, that it's something that I'm considering. But yeah, watch 77.5 and let's see what happens there. But another good one. We're off and roaring here with
You mentioned that this session was a bit of a software teaching session, and I'm sure everyone out there is okay with that. I know I certainly am, and we look forward to releasing tutorials and videos with detailed information on platform functionality and all the features down the road. So I just wanted to highlight, while we were talking about the platform, is when you go over to that cursor, this came from a question in the chat, you won't necessarily see that it changes to the cursor, like as in right now, Rob is on the arrow. So if you were to select crosshair, as in right below it, and you'll now see throughout the chart, Rob is on the crosshair. But if he goes back to cursor and selects arrow,
brings it back to the arrow.
It brings right back to arrow, but it's not quite a noticeable difference. So maybe I'm thinking that might be where the question was from. You don't have to see like a selection or anything. It just automatically is right back to a normal web page of what you would have for every other arrow. Anyhow, I'm digressing. Let's go over to Ego.
EO?
Ego. EGO.
EGO. Yeah, so gold. I haven't looked in the last few minutes, but gold itself was having a big update today. Gosh, it's raining outside. That is so welcome. The yard's burning up with the heat that we've had here in Florida. So that's nice sound to hear. But EGO was one that we actually had an alert on. The AI discovered it back here. One of the beautiful things about the AI, we had some alert subscribers. We had about a 2-week period where we weren't getting any signals and people were getting antsy. But the AI does its job. If the AI is telling us there's nothing strong enough, we were getting both bullish and bearish signals, neither one of them high enough to send out an alert, and the market has gone dead sideways. What direction would you go? So the AI is saying, sit on your hands and wait. So we're not in a habit of sending out alerts just to clutter people's inboxes. We send them out when we have signals that follow the rules and the guidelines that we have listed on our website of what the system is. If it doesn't follow the rules of the system, then we don't send out an alerts. If we have something that's unusual that we like, maybe from our experience, and I say we as far as Jeff and I, then we'll put it in the speculative portfolio. But the AI nailed this one, and it gives you a target price on where it's going to go. And so we got out. And then we had a couple on AEM as well. So we were in the gold space, and EGO has gone through some consolidation. But if it reacts to the movement in gold, at least earlier today, then we could certainly see a blast off here. So from the final read here on EGO, I think if you're looking for one that's consolidated and could take off again, as long as you hold 14, I think you could look long here. The wave 4 is labeled. It was right at a 50% correction. It's sitting on top of support. It's had a nice consolidation, so it's consolidated that big run that it had in March, and maybe it's ready to make that wave 5 run. So I like this one too. If you're aggressive, as you know, I usually try to give both aggressive and conservative views because we all have different risk tolerances. You know what yours are. If you're aggressive, I think you could go long here now. If you're slightly more conservative minded, you would want to wait and let it break above this resistance here at 15.5. So if it breaks above 15.5, you could feel a little bit more comfortable going long. So if you're aggressive, take a shot now as long as it stays above 14. If you're more conservative, let it break above 15.5.
Very well. Thanks, Rob. I'm going to say this last bit quickly. Again, I don't want to digress too far, but as you'll see on the platform that Rob's currently showing, there's that red support widget down there at the bottom. For anything that you see that you feel you're experiencing an error for that Rob is able to do and you are not, it would be very helpful to click that support window. There's a screen capture or a screen recording option. Screen recording option is obviously probably best for our devs to be able to analyze, diagnose, and then reach out with any resolution or information as to what the issue might be, the reason, the cause for it. So it's just one quick button of hitting record screen, and then you can just attempt to do whatever you are doing and experiencing the error, and then send that clip over, and that's far more helpful and efficient to get that issue resolved. Let's go over to PLTR.
Another one that had an alert on, and you can see that we actually sent this out just before we went on today, sent it out this morning. We had a butterfly here. It was a very short-term butterfly. People were asking, is that right? Are you doing a butterfly with just 10 days to go? And the answer was yes, because there was a lot of premium in that area of the mid strike. And so I'm going to give you exactly what we ended up with here on PLTR. We had the 22.5 mid strike, which is right in the middle of the butterfly. The expectation was for this to come down and bounce back up towards the mid spot strike. That's exactly what we got today. So we generated 30% in 5 days on the butterfly. I was going to share this with everybody on Thursday night. The reason for the exit is there was only about 20 cents left of extrinsic value in the 22.5. You take the cost of the option, the value of the option, subtract how much it's in the money, and then that gives you the extrinsic value. So the only way we could have really generated more holding it to Friday is if we come and peg 22.5 dead on. So we would need a continued move higher. So see what happened today is that we broke up. We got near the 22.5 strike, and then we've come back down. You can see the little notch to the right there is where we're currently trading. So we touched the 50-day moving average and came back down. It did exactly what we expected it to do. And 30% in a butterfly in 5 days is a good trade. So that's why we sent the alert to take that one off. So another nice trade there in the time strategy. So Starbucks, PLTR, it's also AI based. So anyway, moving on.
All right, how about two more, and then we'll go to the case study consideration.
Okay.
Let's check out the metals. What's going on with GLD and SLV?
All right. Well, you took me right to the case study consideration. I figured that was coming. So we'll look at them both. That's why I didn't do it before, because silver is going to be, SLV is going to be the case study consideration for this week. You can see the bounce up in gold today, as I was referring to earlier when we were looking at the EGO chart. Again, gold had a bit more of a vertical move than SLV did. And if we can get above that 220 level, then we're probably off and running to the races there in the wave 5. But we have to break above 220 first. It sure looks like we want to. The DMI is trying to, I call this, when it does this, setting up for round 2. And what I mean by that is back here in the strong part of the move, you can see there's your more classic move on the DMI, where the ADX is between the two directional indicators. It's moving up. It got really high. The ADX got up to 60, which is an extremely high level for the ADX. So that was a clear signal that the strongest part of that move was over. One of the reasons that I like the DMI so much. We came back down, and now it's resetting. You can see here the two directional indicators kissed. It came together, and when you saw this, the positive coming down, the negative going up, it looked like they were going to cross and we were going to go negative, but the two indicators come together, they touch, I call it a kiss, and then they move back apart. So now we're getting separation again. You can see the positive ticking up and the negative ticking down. the ADX will need to turn and head back up to confirm that. And I say, or I feel that will happen if we break above 220. So it looks like we're getting another a setup for another run here, where we would have more of a view like this, where there's more separation between the two directional indicators, and then the ADX is moving up, and that's the signal that you want to confirm strength of the move. So the consolidation has brought the ADX back down. There wasn't enough to move the directional indicators bearish, and so it looks like we want to break here. So again, if you're really aggressive, you could probably just go ahead long gold now. If you're more conservative, let it break above 220. As far as SLV, that's going to be the case study consideration for today. Notice the difference here, where the ADX has already started back up. We have more separation between the two directional indicators, so I like this one better. And without a qualified AI signal today, SLV is going to be our case study consideration. It hasn't quite broken, so it's a tiny bit aggressive. It's traded above that 26 level today, but the way the turning of the moving averages is here, there's not a lot of separation between the 10 and the 50. We consolidated for a few days underneath resistance. Looks like we're trying to break above here on that resistance area. So that's why I say it's a tiny bit aggressive. If you wanted to be a little more conservative, let it go ahead and break. Let's see where it goes at the end of the day and what happens tomorrow. But I think this is setting up enough to where it's worthy of a shot right now. With the PPI report coming out, it's renewed a bid in the metals. I just think SLV looks a little bit better set up with the DMI, et cetera, than GLD. But you know the metals, they tend to move together. So there's a likelihood that they both move, and pick your favorite one. But we're going to do SLV as our case study consideration for today. And again, if you hang in there a few more minutes, then Zach will go through and show you how to put that in as an idea or a post on the website. You can do it yourself. You have ideas, other people can come in and vote on them. So that's kind of cool. It's always neat to see what other people think of your own ideas. It's a really cool feature in the software. So let's get the next symbol done, and then Zach will show us how to do it and how you can do it.
All right, that sounds great. Well, let's go ahead and look at GME. I'm sure you've heard all the news with Roaring Kitty making the appearance and rallying that stock up. I think it was like 118% return, like 19 points or dollars. But anyhow, it's been tanking quite drastically in the last hour, as Will noted. And we had a little fun in the chat about that, so I wanted to hear your thoughts.
Well, Roaring Kitty's back. The whole meme thing is back. There was 24% short interest in GME. And one of the things that I want to be really clear on is here's when Roaring Kitty started talking about it. And you can see that, it moved it up a little bit. But I don't care how many followers Roaring Kitty has. There's not enough retail strength to create moves like this. And that's what occurred in the meme craze, is when they were doing this, institutions caught wind of it. And so the institutions would jump in. They're the ones that have the kind of volume. Look at these two volume days. Let me take the DMI off. There's no retail trading that can generate this kind of volume. So there's an institution in there. There was a big institution. I think it's Melvin Capital, but something that was heavily short. And so you had not just short interest from retail side, you had short interest from institutions. And so some other institution came in and said they're going to basically stick it to them, knowing that that institution would have to cover their short position, and that would create the volume. So it takes institutional buying to come in. Now, there was all sorts of investigations back in the meme craze when this kind of stuff was happening, with GME, AMC, et cetera. And to my knowledge, nothing really happened. It's kind of a slap on the hand, don't do that. Well, they're doing it again. So if there's not going to be any repercussions for doing it, it gets sticky though, right? Because what are the regulators going to say? One institution says we had a bullish view, and that other institution had a bearish view. So we bought, they covered. That's not our fault. So it's a difficult thing to come in and regulate. So nothing really happened. So now it's happening again, and I think AMC is involved again as well. But I just want to be really clear for the people watching: stay away from that stuff. Please stay away from it, because you don't know when that institution's going to bail. And as soon as that institution bails, then you're going to get caught on the other side of this trade. You don't know when they're going to say, okay, that's enough of a gain, and they're going to sell. You'll see, huh?
And I said, once it's enough of a gain and time to dump, and then that's
the old bum and dump thing, right? But just please understand, it's not retail traders doing this; it's institutions that are monitoring and following along with the comments, and they find an opportunity to step in, and so then all the media goes after this roaring kitty guy and all this stuff, but this is institutional stuff going on, and you don't want to get caught on the wrong side of this. And that's what happened. All those people that made a bunch of money following along with this during the meme craze, during the pandemic, all got wiped out, and it all went away. And it went away for a couple years because they all got killed. And now we're doing it again. So the same exact thing is going to happen again. Please don't chase these. If you happen to get lucky on one and made some money, great, but please don't start looking for this stuff again. Let's not do that again, where a whole bunch of retail traders get caught on the wrong side and get wiped out. Just look at it for what it is, and stay away from it. Because you can already see how much lower we are on AMC, where we opened way up here, and now we're way back down here. And you don't know when they're going to get out. So it's
Thanks for that, Rob, because I think that was really important, especially highlighting the volume metric. I mean, I think that makes it very clear. If you look at just historical volume for any chart, especially with between AMC and GME, there's just no type of retail volume or retail impact that can create that drive in volume as the institutions can. So that alone right there should, I think, answer a lot of questions around that.
Well, I hope so, because it's misreported in the media. They don't really talk about it. They finally did after a while. They didn't really bring it up until people started losing all their money. And then it kind of came out about the whole institutional side of things. But, it was all, ooh. And granted, a few people made a lot of money off of it. But they didn't make money off of it because they were sticking it to the man, and they were finding stocks with heavy short interest. And then they, force these short. There's no amount of retail public that can force an institution to cover a short position. Another institution can, but the retail public can't. The retail public volume versus institutional volume is not even close. So I'm glad we had a chance to go through that. I figured that stock was going to come up. I was going to show it earlier, but I figured somebody was going to ask about it. But just stay away from it unless it's just complete play money, and you're willing to lose it, which is likely what's going to happen. If you happen to hit one, don't stay in the game. Please just stay away from this stuff. It's not worth it. Now, AMC, they were really smart. They were probably going out of business when this happened last time, and the principals came in and sold a whole bunch of shares and shored up their balance sheet. So they took advantage of it because they already own the stock, and they did it again. So the principals are selling. The principals of AMC have been selling into this so that they can survive. And they're working up all kind of new ideas to do with theaters, and more power to them. They're being smart about it. They're like, holy cow, this is a gift from above. And it's giving us a chance to figure out what we can do to change our business model. There's this rhetoric, we're going into a new gaming cycle, and that's why GME went up. No, it's not. It's because an institution came in and bought. That has nothing to do with it. But AMC was smart last time this happened, and they've been smart again this time, selling into this craziness here. And then you can see, boom. So if you're right here and you're thinking, all right, here we go again, and then bam, that's what happens to you. So just, again, please stay away from it. But
Absolutely. And we apologize
figured
for
that
running a
was
bit
gonna
long
come
on
up.
this session, but I think that was some very, very important context to share. So I appreciate you taking the time to do that, Rob.
Yeah, and we said that we'd do a little bit more on the Q&A, so I'm really happy that was how we finished things off. So if you want to grab the screen and show the people how they can post an idea on our website that stays away from crazy land, then let you fire it up.
Well, no, I'm actually glad you brought that up, and I think my screen's coming up here now. When you had mentioned earlier about the super cool feature where you can vote on ideas and see what other people will just think about your idea, aside from what they think about it, there's also a trust ranking that's factored into that as well. So just as your trust ranking of if your idea pans out and you hit your price target, or vice versa, it doesn't, and your option expires within the time frame and you're at a loss, that impacts your trust rank that you'll see throughout the profile that every single member has an association with. Now, when you vote on ideas and you happen to vote on an idea that pans out to hit the target price, that increases your trust rank, and the opposite for if you vote against an idea and it does the opposite, it's going to decrease your score. So it's also something to keep in mind to really analyze these ideas, really get an idea. Don't want to use idea too much, but really get a solid understanding of the idea as a whole before voting on it, as it does have some impact on your overall trust rank and score too. So we have plenty more tutorials and videos coming out soon. We're diligently working on those, so please stay patient. We understand the anticipation around it and are looking forward to releasing those here in the near future. This is just a jumping off point, a menu view of the Hub platform. Again, with us going a little bit longer on this session, I won't spend too much time on going through the different areas like I normally do. We'll have to do that again next session. But to create an idea, as you can see, I click the light bulb there, and that brings me to all of the ideas here. Now, if you ever want to just filter it out down to your ideas, you have the option to go to My Ideas. And if you feel like there's some ideas that you may not have voted on yet, you can go to Votes Needed and find those ideas there. So, Rob, are we going to go with an idea for this one or a post?
Let's do a post on this one. No, and
Okay.
let's make it
so everyone understands the definition. Go ahead.
Yeah, go ahead. Let's do an idea.
Okay. All right. Yeah. So I was going to say, just so everyone understands the difference between those, is an idea is essentially as if you are ready to execute this trade. Look at it as paper trading, as in you are in this position, all real data, everything is up to date and current, exactly what would happen if it was real money, real risk, real capital on the line. Now, obviously, it's not. It's just an idea. You're not actually, trading through a brokerage on the idea. Is just posting the idea. But again, all of that information is real time. So view that as paper trading, and when you're ready to enter whatever position it may be. A post you can look at as like a draft idea, as in it's something you're monitoring, it's on your watch list, the criteria is maybe almost met, but not fully there yet. So you want to give it a bit more time before you commit to having it as an idea that will eventually impact your trust rank and where you rank throughout the member community. So we'll go to create idea here. It's going to be SLV. And obviously we will come back and make this a lot prettier. We always encourage and emphasize our subscribers to make sure they take the time to add as much detail as they can, whether it be charts, showing what indicators they're looking at that's making them feel more confident in their position, all of the detail, all the macro factors, anything at all, as those will be picked up in these tags here at the bottom. And you can find your ideas through themes. You can find other people's ideas that are in the similar sector through the themes that the tags will pick up here. So just as a quick example, I can just put AI here, or maybe artificial intelligence. Like it's spelled today. Or sorry, it's an AI stock. Anyways, I don't want to take too much time away from it. What's our target price here, Rob?
29 in 3 months.
In 3 months. So if I were to change that to NVIDIA or something, then you would see AI and whatnot come up here. I'd realize that I didn't have an AI stock there, but that's how those tags work. And so to be continued, we are at 15 over, and I don't want to take any more time away from everyone's trading day. I know Rob has to get back to the markets. I do as well, and I'm sure all of our attendees do in addition. So thank you so much for the time that you dedicate to us each week. We can't thank you enough. It genuinely means a lot to us, especially with how valuable our time is now more than ever. And we look forward to interacting with you again in the near future. I'll pass it back over to you, Rob, to wrap things up.
I just wanted to further on your comments about the software. Just remind everybody we're in beta form. In all the cool features that are going to be on it aren't there yet, but it's cool enough already. And we get updates. We have a management meeting every week at Elliott Options, and lately the hub programmers have been kind enough to come in periodically and update us on the new things that are going to be in the software. So we're getting just, we wish we had them all out there now, but, programming takes time, especially, and I want to highlight this, they did not take the legacy software and new, improve, and update it. They started this from scratch. So if you have any programming background, you know how long that takes. So as Zach pointed out, the support, finding little things that maybe little tiny bugs or whatever is very helpful, speeds up the process for everybody because the programmers are busily working on the new stuff. And that's where your help comes in on helping us improve what's out already. But it's just in beta form. It's not even close to all the cool things that are going to be there. Every time we talk to those guys, it just gets more exciting. So thanks, as Zach said. I said we'd run long today, so hopefully you found this informative. We do respect your time, and as Zach said, during the trading day, our time's valuable as well. So hopefully you enjoyed that. I hope you have a great rest of your day. Let's see what the CPI report says tomorrow. And for all our alert subscribers at evotrader.com, we'll see you Thursday night in the insiders meeting. Take care, everybody.
Take care.